Hello friends, welcome back to my channel. Today we will be discussing a very serious topic. Is a wave of IPOs a sign of good times ahead or a warning of an impending crash? History tells us it might be the latter. Today we are exploring the link between a surge in IPOs and potential stock market corrections. We'll examine the Indian market's recent IPO boom, analyze the underlying psychology, and uncover why investors should pay attention to this signal. So let's get started. First, we'll see the historical data. So the Indian IPO market has been booming since 2021. 2021 was the biggest year in Indian stock market, IPO market, and total number of 63 companies got listed, and they raised 1,18,704 crore rupees. This the coming year 2024 is going to be the biggest year because total number of 64 IPOs have been planned so far, and they are going to increase. They are going to raise an amount of 1 lakh crore rupees. And mind you, this is an election year, and the stock market boom is expected to continue at least till general elections. So many more companies will join the fray, and this can be the biggest year in history for IPOs so far. So let's see how these IPOs have fared till now. While some companies like Glenmark Pharma, Adani Wilmar, Zydus Life Sciences, they have given very good returns, some have not fared very well, like Zomato, Nykaa, Delivery, Paytm, and LIC. And mind you, these were the biggest names when this IPO came. There was a lot of buzz. LIC, it was the biggest IPO in the history of Indian stock market. So let's see the reason for the surge in IPO. In a bull market, investors, they become very overconfident. Companies rush to capitalize on the higher valuations, and they want to ride the tide. They want to raise money on higher valuation because the investors have become overconfident. Less scrutiny on IPO quality. Investors, they start putting money on each and everything because they say that everything is giving returns because of the bull market and overconfidence of the investors. Increased risk of overvaluation and poor post-IPO performance. So overvaluation leads to poor post-IPO performance, like we have seen the companies which have given not very good return. So we'll see what history tells us. There are some examples of IPO booms preceding corrections. The first is the dot-com bubble. In the late 1990s, the US witnessed an unprecedented IPO boom, especially for internet and technology companies. Excitement surrounding the new economy led to aggressive valuations and a surge in IPO fundraising. In 2000, the IPO bubble burst, leading to a dramatic market crash. Overvalued tech companies plummeted, wiping out billions of dollars and eroding investor confidence. The second, Japanese asset price bubble. It was fueled by an easy credit and speculation. Japan experienced a massive asset price bubble in the late 1980s. Real estate and stock prices soared, attracting numerous IPOs, particularly in the financial sector. The bubble burst in 1991, leading to a prolonged period of economic stagnation known as the lost decade. Stock prices tumbled, bankrupted companies, and caused widespread financial hardship. The IPO fever of 2007. In 2007, the US market saw another surge in IPO activity, with companies across various sectors raising record amounts. Enthusiasm for financial institutions and private equity firms fueled the boom. The same year, the global financial crisis erupted, triggered by the subprime mortgage crisis. Stock market plummeted, causing significant losses for many recent IPOs and highlighting their vulnerability to broader economic downturns. So, should we be scared? We should not be fearful, but watchful. We should watch for the red flags. What are the red flags? The first red flag is high P ratio at IPO, suggesting overvaluation. So we should be watching the P ratios of the companies and only investing if they are worth investing as per their valuations. Weaker financial fundamentals among listing companies. So we have seen in recent time many companies coming up with IPOs having losses, and still investors are pouring money into them. So we should be watchful, and we should only invest in fundamentally strong companies. A shift in investor sentiment from optimism to caution. If there is a shift in investor sentiment, especially from DIIs, II, and FIIs, from optimism to caution, then we should also be cautious, and we should not be putting money in IPOs at that time. What are the lessons for the investors? The investors should exercise caution during IPO booms. They should conduct thorough due diligence on IPO companies. They should diversify investment to mitigate risk. So, what is the conclusion? A surge in IPO can be a red flag for investors, signaling potential overvaluation and market corrections. It is important to be vigilant and take careful investment decision. So we should not fear, friends, but we should be cautious, and we should be exercising due diligence on each and every money, because each and every IPO, because we are putting our money, hard-earned money, in them. And if we are not cautious ourselves, we should not blame the market for the correction and the losses we will be incurring. So I think this video should be helpful to you. Do all the due diligence before investing your money. If you find this video to be helpful, please like this video. If you want this information to reach to your friends, your colleagues, please share this video and subscribe to my channel. I am thankful to all of you for watching this video till the end. We'll see you again with the next video. Thank you so much. Bye bye.